Welcome back, everyone, and thanks for joining me again. Today, we're diving into a story that's been creating a lot of buzz in the financial world, especially among investors who track major payment and fintech players. We're talking about Fiserv, ticker symbol FISV, one of the giants in digital payments and financial technology. But something unusual has happened recently, something we don't normally see with this company, and it's pulling a lot of attention from Wall Street analysts, institutional investors, and everyday shareholders. So in this video, we're going to unpack exactly what happened, why several analysts suddenly cooled on the stock, and whether this unexpected shift could actually be setting the stage for a major buying opportunity. So let's break it down step by step, starting with the big move by Creative Planning, one of the well-known institutional investors. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. During the second quarter, Creative Planning, yes, the same Creative Planning known for its massive diversified holdings, quietly trimmed its position in Fiserv. According to their latest 13F filing with the SEC, they sold off just under 14,000 shares, which works out to a reduction of about 5.7%. After this adjustment, their remaining stake sits at 232,025 shares, worth just over $40 million at the end of that reporting period. Now, on the surface, this isn't the kind of move that shakes the earth. Institutional investors regularly make these types of adjustments. But the timing of this particular sale, paired with several analyst downgrades, created a ripple of uncertainty around Fiserv that investors can't ignore. The company's stock has been hovering near its 52-week low, opening recently at roughly $63 per share, which is dramatically below its high of $238. And yes, you heard that correctly. A fall from $238 to the low 60s. That's the kind of drop that forces investors to stop and reassess what's actually happening under the hood. Before we get into analyst sentiment, it's worth looking at what other institutional investors have been doing. Interestingly, while Creative Planning took some chips off the table, several much smaller institutional players quietly increased their Fiserv exposure. Activist Wealth Management, for example, boosted its holdings by more than 3,100% in the first quarter. Now, granted, this increase moved them from owning 4 shares to about 130, but the percentage change still turns heads. Similarly, firms like Golden State Wealth Management and Christopher J. Hasenberg, Inc. made significant percentage increases in their tiny positions as well. These are not massive moves in dollar terms, but they do show that smaller firms still see value in Fiserv at these price levels. And when you zoom out, around 130 of the stock is held by institutions, which means big money continues to have strong control over this company's destiny. Now let's talk about the elephant in the room, analyst downgrades. This is where things get interesting. A string of major research firms issued revised ratings on Fiserv, and the general theme was the same: cooling expectations. TD Cowen dropped the stock from buy to hold while setting an $80 price target. Sanford Bernstein took an even bigger step by reducing their target from $205 all the way down to $80. When a firm cuts a price forecast by more than half, people notice. Meanwhile, Stevens and Argus both shifted to neutral stances too. Across the entire coverage universe, the data now shows 11 analysts maintaining a buy rating, but 23 saying hold and 2 recommending sell. The overall consensus is now squarely in hold territory, with an average target price of $123.25. So analysts aren't saying Fiserv is doomed, but they're also not calling it a runaway winner right now. The sentiment is cautious, especially after such a dramatic drop from its highs. Let's look at the stock's actual performance metrics. At its recent price around $63, Fiserv carries a market cap of roughly $34.5 billion and a P/E ratio under 10. That's low, extremely low for a technology-driven financial services company. It also has a PEG ratio around 0.56, suggesting the market may be undervaluing its growth prospects. Its liquidity position looks stable with a quick ratio of 1.09 and a current ratio of 1.08, while the debt-to-equity ratio of 1.15 shows moderately high leverage, but still within normal ranges for a company of this size, operating in digital payments. Now here's where things get really interesting: earnings performance. Despite all the market anxiety, Fiserv actually posted solid numbers earlier this year. In the quarter ending March 26th, the company reported $1.91 per share in earnings, supported by revenues north of $4.3 billion. Not only was profitability strong, Fiserv logged a net margin of 17%, but the company also delivered a return on equity near 19.5%, which would be impressive for any large-cap financial technology firm. Analysts still expect Fiserv to bring in about $10.23 in earnings per share for the full year. So fundamentally, the business is performing well, even while the stock price suggests something is broken. And that brings us to one of the most shocking developments: insider buying. Yes, insiders bought the dip. Director Lance Fritz grabbed 10,000 shares at roughly $65 each. That's more than $650,000 invested personally. When board members spend their own money buying shares, especially in large amounts, it often signals confidence. Fritz increased his stake by over 324% in one move, giving him just over 13,000 shares total. Insider buying doesn't guarantee a stock will rebound, but historically it's often a leading indicator that a company is undervalued. So now the big question: what does all this mean for investors? Fiserv is clearly in a unique moment. The valuation is low, analysts are cautious, the stock is beaten down, big institutions are mixed, but the company's financial performance remains strong. Add insider buying to the mix, and you get a picture that's complex, but potentially compelling for long-term investors. To wrap everything up, creative planning reduced its Fiserv holdings, sparking concern right as several analysts downgraded the stock and slashed their price targets. The share price is near the low end of its 52-week range, far below its earlier highs. Yet smaller institutions have been quietly adding shares. The company continues to report strong earnings, and insiders themselves are buying into the stock. This combination creates a fascinating setup, one where fear and value collide. Whether Fiserv becomes a big rebound story or continues facing pressure depends on upcoming earnings, industry momentum, and whether investor sentiment shifts. For now, the market may be overlooking a company that still delivers strong fundamentals. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.